the economy is teetering on the brink of recession, and the country struggles to recover from the coronavirus. In less than 75 days, we have one of the most important presidential elections in history. So if you're like most Americans, most voters, and most investors, you're wondering, how can I position my investment portfolio to take advantage of any opportunities or to avoid any pitfalls associated with the presidential election? Hi, my name is Chaz Price, and I'm a certified financial planner for America's Retirement Headquarters here in Maumee, Ohio. And I'm here to talk to you today about some simple, smart strategies that you can implement in your portfolio today to make sure that you are in a position of strength come November. So let's get started. Now first, I have to preface this conversation by saying that normally any investor that has a long-term time frame and a well-diversified portfolio is going to enjoy rising stock prices. In fact, there's only two presidents in history that have started their presidential year with the stock market being higher than when they finished 4 years later. Those were President George W. Bush, and Richard Nixon. So normally, as I said, you're going to enjoy great returns in the stock market if you have long-term time frames. However, given the stark contrast between these two presidential candidates particularly, also adding in the fact that we've had some of the most explosive, almost violent market reaction to the coronavirus, and by the way, we've had some of the most divisive monetary policies in history, excessive spending, I really feel that this presidential election is going to be extremely important for many years to come and will have some very huge implications on a number of sectors. So first of all, I want to look at each party's political philosophy as it pertains to investments. So we call that our playbook, or our presidential playbook. And so if we look at the Democratic Party, typically we're going to lean more towards more defensive sectors like utilities, like communication services, and consumer staples. And the thought being that oftentimes the Democratic Party will use what we refer to as maybe corporate unfriendly policies, policies that are somewhat designed to spur the economy and to grow it through a redistribution of wealth, where we move monies from higher wage earners and higher taxpayers to maybe lower middle income taxpayers. And we do that through higher wages. We do that through infrastructure spending and more robust healthcare reforms. And so those policies are typically not viewed as favorable in the stock market. To contrast, the Republican modus operandi typically is what we would refer to as corporate-friendly policies that typically involve tax cuts as well as deregulation of policies and procedures. I think a great example of that Republican agenda would be the Tax Cuts and Jobs Act that was passed by President Trump in 2017. This act, probably some of the most important tax legislation we had in generations, lowered the corporate tax rate from 35% down to 21%, and it also almost doubled the standard deduction for most individual filers. So if we look at then how we position our clients' portfolios for either event, we've got really our investment playbook, our presidential playbook that we refer to, is going to be very similar to our 2016 playbook. And the reason being is that we are leaning more towards presidential second term for President Trump. And so if you look back in history since 1928, there's been 14 times when the market was up 3 months prior to the election. In 12 out of those 14 times, the incumbent president has won a second term. Of the 8 times that the market was down 3 months prior to the election, that signaled and that's ushered in a new presidential candidate, a new political party into the White House. So again, we're leaning more towards a second term for President Trump. Now, what that also could mean is that if President Trump does get a second term, that could provide a significant tailwind for some of our smaller, more medium-sized companies that stand to benefit most from this reshoring initiative, or kind of the opposite of what we saw in the early 90s and 2000s, where we were offshoring most of our production and manufacturing to emerging markets like China and India, Russia, Brazil. And these smaller, medium-sized companies are perfectly positioned because they're the ones that are taking advantage of and utilizing automation, artificial intelligence, and robotics technologies to try to make our products and services more competitive and more from a price standpoint. But regardless, whoever wins, and at the end of the day, the market doesn't care, what our opinions are, so we need to be prepared for either event. We know that either way there's going to be a lot of choppiness, a lot of ups and downs in the market. And so the advisors at America's Retirement Headquarters have developed 3 portfolios to help you weather whatever storm may be lingering and may be looming as a result of the presidential election. So first of all, if you're kind of the opinion that things are getting worse, or that things might get worse as a result of the election outcome, we have our consumer staples portfolio ready. In the consumer staples portfolio are stocks that have a constant demand, if you will, regardless of what the economy or what the market is doing, if it's good or bad, up or down. These are companies that provide us our food and our beverages and our household items and our toiletries and things like that. And so there's a constant demand, which helps them to be perceived more defensive and to hold up a little bit better sometimes when the market is correcting or going down. Conversely, if you feel that we're getting better and things are going to be much brighter as a result of the election, we have our capital strength portfolio. And our capital strength portfolio is a portfolio that's more designed for growth-oriented investing. And so these are still pillars of the economy, household names in the technology, the aerospace and defense, industrial, energy names that you've known and heard of. But to further protect our clients, what we've done in this new economy where cash is king, we've further sorted the names and kept only the names in a very tight portfolio that have significant leadership ability. They have strong balance sheets. They have double-digit return on equity already, and then most importantly, they have low debt and more than $1 billion in cash, which is important in these days when cash is king again. So to kind of round out our portfolio there, we have probably one of our most aggressive or speculative investments. We have our small and mid-sized cap strength portfolio, which is essentially the same criteria only as our capital strength portfolio, but only on a small and medium-sized capitalization level. So what we're looking at then are the same 5 criteria, but the companies only need to have $100 million in cash. So as you can see, we've kind of covered a lot of our bases. So regardless of the outcome of the election, if you're still concerned about what could happen, what could be the result of the presidential election on your portfolio, give the advisors at America's Retirement Headquarters a phone call. We are financial professionals that specialize in working with individuals that are in or close to retirement, and we have the tools, the technology, and the talent to assess all of the risks that may be affecting your portfolio as a result of the presidential election, and not just the ones that are dominating the headlines today. Again, my name is Chaz Price. I'm a certified financial planner at America's Retirement Headquarters. Give us a call at 419-842-0550. Thank you.